What's up, everybody? So we are back for episode number 6. I'm excited. It's just me again, obviously. So we're going to try to keep it short and sweet. I just wanted to go over mostly retirement plan surrounded topics today, specifically from the perspective of tax savings, both for 2024, the year that just passed that we're filing tax returns for now, and for 2025 going forward, just in case, you didn't have the means or don't have the means to still catch up for the things that are available to you for 2024. At least you'll know maybe how to better plan for 2025 should these options be available and possible for you, doable. So I'm just gonna jump right into it. No pleasantries today. So retirement plan contributions. It's not too late to still make retirement plan contributions for 2024 for some, if not most people. So keep in mind, for the people who are just individuals working for somebody, you're on a W-2. Your really only option at this point is going to be your traditional and Roth IRA catch-ups. So you have until the filing due date, April 15th or October 15th, if you end up extending, to contribute for your retirement plans for last year. So remember, there are thresholds that determine which plan you can contribute to directly, whether your contributions will be deductible. So many, if not most people, like to contribute to the Roth plan. If not directly to the Roth, then through the backdoor Roth IRA method. So remember, I said there are income thresholds to contribute to the Roth plan. If you're below the income threshold to contribute to the Roth, you can put your money directly into it. It's up to $7,000 for last year, $8,000 if you're age 55 or older, because you get that little catch-up window as well. This is not the type of plan that can be like a joint account, keep in mind. So it's one for you, one for your spouse. Possibly your kids have one too. So remember, money you contribute directly into a Roth, you can withdraw at any point, no matter what, specifically the dollars that you contributed. Any earnings in the Roth, you will pay income tax on them if you withdraw prior to age 59 and a half, and you will pay a 10% penalty on early withdrawal on the earnings portion. Again, if you contribute money directly to a Roth, you can withdraw those dollars at any time. So I like to look at that as kind of like a rainy day savings account. It's very good to take advantage of. If you're not eligible to contribute directly to a Roth, you would contribute to a traditional IRA. Now, traditional IRAs are pre-tax, right? So potentially you get a tax benefit, a tax deduction for putting money into the traditional IRA. The limits are the same, up to $7,000 for last year and up to $8,000 if you are age 55 or older when you're contributing. There are income thresholds for the traditional IRA as well. If you are over that income threshold, and it depends on if you receive the opportunity to contribute to a 401k, 403b, a workplace retirement plan or not. If you exceed those thresholds, you can contribute to the traditional, but your contributions are considered non-deductible. So in this case, your best bet is not to even hesitate. Put money into the traditional, convert the money into your Roth plan right away as soon as the dollars clear in the account, because they were not pre-tax dollars for you regardless. So you might as well put it into the Roth. So at least the growth on that money is going to be tax advantaged. Otherwise, you're putting non-pre-tax dollars into a traditional IRA, but the growth will be taxed upon your withdrawal ultimately. There are nuances, there are caveats. It's very difficult to go through all of them. They're very individualized. So I always recommend that you reach out to your tax professional to talk about, what strategy is best for you. And not just your tax professional, by the way, but a financial advisor if you have one as well, and if you can afford to speak with one. So that's catch-ups for last year for the employed. Now, for the self-employed, you have a few more options. If you have a SEP IRA, if you have a simple IRA, you also have until the tax filing deadline to contribute money into there. Your limits are much higher, potentially as high as $69,000 for last year. You have to, there's also income limitations, calculations that go into this. You must consult with your tax professional before you contribute money in there. If you over contribute and don't withdraw that over contribution by the tax filing deadline, you will be penalized. You will be penalized on the over contribution. So be very meticulous and careful. For those of you who are self-employed and have 401ks or solo 401ks inside of your business, your personal individual deferment amounts, the ones that maxed out at 23,000, those were due by December 31st. However, the employer match or the profit share is due by the due date of your tax return. So if you have an S corp, March 15th, or the extension deadline of September 15th. If you don't have an S corp, if you're just a single member LLC, a partnership, or just a sole proprietor with no legal entity, then it's your personal tax filing deadline of April 15th or October 15th if you extend. So remember, you could potentially throw a lot of dollars into one of those plans if you have those dollars available, and they may help your tax situation immensely. At this point, I would say get your tax return prepared first, see where you stand, see by how much you crossed into the next income tax bracket level and what you need to bring yourself back down a little bit. So see how advantageous those dollars will be. Or maybe, if money is a little bit limited for you and you can't max out for both 2024 and 2025, maybe you save it for 2025, depending on your income outlook for this year. Maybe you only worked half of the year last year, but this year you're going to work a full year, you're going to have a higher income, you're going to be on a higher tax bracket. And so contributing for this year in a pre-tax manner or a tax deductible manner from the employer's side will be more beneficial for you. Again, tons of nuance and caveats to how to do this. So you must consult with somebody unless you're a professional yourself and you just know what you're doing already. That's possible as well. Here's another thing I like to touch on, and this is for the lower income households on paper, meaning you can be a high income household, but through maybe rental property depreciation or big purchases inside of your business, your adjusted gross income reported on your tax return still comes out to a low level. You may be able to take advantage of this. If you have kids who recently graduated college, they're no longer dependents, they're definitely not going to know about this. So you want them to look into this as well. And it's something called a saver's credit. So there is a potential tax credit for people with a small adjusted gross income for the year to receive a credit against the money that they put into a retirement plan. It could be a workplace plan, a 401k, 403b, 457, and so on. It could be an individual plan. It could be an IRA, a Roth IRA, a SEP IRA, anything you're contributing. So there are, of course, as always, thresholds, income limits to this as well. I'll give you the simple overview, but they go with phase outs. So if you're filing as single or married filing separately and your adjusted gross income is under $38,250 for 2024, okay, you will receive at least a 10% credit against your contributions to one of those retirement plans and as much as a 50% credit. So it's possible you can get a nice chunk of your money back just by contributing to that plan. And remember, you contribute dollars to the Roth IRA, you can withdraw them whenever you need to and get a 50% credit. I mean, that's quite beneficial. If you're married filing jointly, the threshold is $76,500. Got to be below that. And if you are head of the household, so you're not married, but you do claim dependents on your tax return that qualify you for the head of household status, be very careful with determining that. The threshold is $57,375. It goes up with inflation a little bit every year. So 2025 will be slightly larger numbers in terms of that threshold. Very, very, very important. What's up, everybody? I just wanted to interrupt for a quick second to say, please, if you're enjoying this, like this video, bookmark it, subscribe to the channel. It really helps me a lot. Share this with your friends. I appreciate you all as always. And now back to the video. And when your tax preparer is preparing your tax return, this is not something that necessarily will automatically pop up for them if they're using software. Your tax preparers, your professionals have to be on top of this and making sure they look for this for you and or tell you ways to get below that threshold if you're very close to it so that you can qualify. for this tax credit. Again, could be very beneficial. And that goes for whether you're self-employed or you are employed by somebody else. So that's that. I mentioned the 401k profit share employer match, the SEP IRA. Sorry, I just have some notes here for myself to make sure that I don't forget to say anything. Also, a couple of kind of hints. There's something called a spousal IRA. So if you're married, you guys live together, and only one of you works. So you have stay-at-home mom, stay-at-home dad, or maybe there's disability involved or something of that nature. Whatever the case, whatever your case is, there's something called a spousal IRA. So if the working spouse has enough earned income for both of you to contribute to a traditional Roth IRA, both of you can contribute. So remember, up to $7,000 per year per person, or $8,000 if you're age 55 or older. So as long as there's enough earned income in the household to cover that 14 or 16,000, you can both max out. A lot of people don't know about this. This is also a powerful tool for you both. For both from like a retirement savings standpoint and a tax saving standpoint, whether those tax savings come today or in the future if you're doing a Roth style plan. Roth conversions, right? So there are people who have been packing money into their traditional IRA over the years, or they maybe had a 401k from a previous job. When they left that job, they closed the 401k and rolled that money over into an individual retirement account, whether by their own choice or because they were forced out of that 401k plan, like the employer, would no longer sponsor it for them once they were gone. When that rolls over, it's likely going to roll over. If it was pre-tax 401k at work, it's going to be a pre-tax traditional IRA, rollover IRA. Now, if you've stopped working, if you had a very low income year, if any of these things happen, if you're retired and you don't have any retirement income that you're taking right now, there may be potential for it to be a good decision for you to convert some money little by little every year into a Roth IRA, because your tax consequence of rolling that smaller amount might be slim to none today, versus you might have a higher income year in the future. Either you're going to get a job again, or your income's going to go back up, or you're going to open a business, or you're going to start taking retirement distributions from your retirement plans. This could be a good idea. Again, very important and nuanced for you to talk to your financial advisor and your tax professional in this sense. By the way, if you don't have a financial advisor, but your money is invested with a brokerage, you can usually call those brokerage firms. I mean, now this isn't going to be somebody that you speak to there that's fully invested in your situation like your financial advisor will be, but at least like that basic level of information they should be able to provide you with. And at the end of the day, I mean, you are investing with their brokerage firm, right? And that's whether it's a Fidelity or a Vanguard or some small shop locally. Always ask. Always worth the call and a question. That's free to ask. The other thing, and just because this week, there was a big dip in the stock market and in cryptocurrency over the weekend with, the tariff news coming out. Crypto tax loss harvesting is super flexible. Tax loss harvesting is when you have money invested in a stock or a mutual fund or an ETF, or wherever your money is invested in a brokerage firm. Money's invested, there's a dip in the market, and so now the value of your investment has dipped below a profit level. You're in the losses now. Normally, tax loss harvesting is done at the very end of the year, November, December, preparing for the close of the year, when we're talking about stocks and even when we're talking about crypto. And what it does is it lets you realize the loss you have on these investments by selling that investment and putting the money into something completely different. When it comes to regularly traded stocks, ETFs, mutual funds, and so on, the traditional stuff, you cannot sell off that stock to take that loss and then put your money right back in within 30 days of selling that stock, because your losses will become disallowed for now. They'll become deferred to a later time. That doesn't yet exist with cryptocurrency. I could sell my Bitcoin at a loss today, for example, if it was Bitcoin, and reinvest into it an hour later. And now I've realized those losses on my books. They'll help offset any gains or some regular income that I have. and I'm still invested in Bitcoin at the end of the day. And we go forward and we hope that it pops back up and you get back into the profit level. So just an interesting strategy to take advantage of. Again, everything I'm saying here today is to put thoughts into your head, not necessarily immediate action. Ask questions. Everyone's situation is nuanced. We're all in different tax brackets. We have different family situations. We live in different states, different countries. So everyone's situation is going to be different. You want to call and ask about your personal situation. So that's pretty much it for today. Like I said, I was going to keep it short and sweet. I think we're like, 15, maybe 20 minutes in. These are important talking points for the tax season, in my opinion, because this is where you can still do things for less. Oh, by the way, I think I forgot one. Make sure that you're keeping track. If you do not get your health insurance through the workplace, but you're getting it through the marketplace instead, self-employed health insurance is still pre-tax. So you should be able to deduct it on your tax returns. Make sure you're letting your tax preparers know. There are so many questions that we have to ask you when we're preparing a tax return. It's not unreasonable that things get lost in translation or missed for any type of reason. So you gotta bring things to your tax professional sometimes. Self-employed health insurance, or health insurance that you paid for outside of the workplace, or even if you're dealing with a COBRA plan in between jobs, this is something to mention. Long-term care insurance premiums. So usually as people get a little bit older, they'll start to invest in long-term care premiums. Those may be deductible as well. Your ordinary medical expenses may be deductible as well. Whether they are or they aren't, and you don't know during the year, collect those receipts anyways. Give your tax professionals a total. This is how much I paid in copays. This is how much I paid in deductibles. This is how much I paid for my prescription eyewear. This is how much I paid for over-the-counter drugs. Have that all listed. It might help you. Not necessarily, but it could. It's worth the ask. All right. I'll leave you guys with that. All that being said, if you have any questions, as always, reach out, ask, DM me, schedule a consultation. 20 minutes is always at no charge. Please like, share, subscribe. I know this information is valuable. That's why I'm giving it to you, and I hope that you could share it with your friends and family. If there's anything you want to hear about in the future, if there's anybody you'd like me to talk to that would be willing to speak with me, I would love to. I'd be more than happy to, and I'd be excited. And with that being said, I'll see you guys soon.